Okay, so in this recording, we're going to go through the case study question that you had for homework, which looked at the tax implications of a share v asset sale. In this question, you were asked in the requirements, and I always look at the requirements first before I read down through the case study information, because it gives us a little better sense of what we're required to do as we're reading the question. So in this question, we're asked to analyse the tax implications of a share sale and an asset sale. We're given the dates that the disposal is expected to take place, so by the end of 2024, and we're given values based on the 1st of December 2024, and you can assume that they're not going to change by the date of the eventual sale. We're asked to advise Mr. Strike which option is the most tax efficient option for him, bearing in mind his intentions. So as we're reading down through the case study, we'll have to identify what are Mr. Strike's intentions in relation to the use of the net proceeds, and you're required to support your answer with calculations. So that means that I'm going to have to do some calculations and some writing. So to read down through the case study, we're told that Mr. Strike, who's aged 40. As soon as I see that he's aged 40, I know that retirement relief is off the table. But in the exam, I can throw down that comment that he doesn't qualify for retirement relief on the basis that he's not age 55. He owns 100% of the shares in Footloose Limited, a shoe trading business. He is the sole shareholder and managing director for 10 years. And the base cost of his shares is 100,000. We're given the information then about what he wants to do. We're told he wants to sell the business to realise cash to pay off personal debts. So we said that in the requirements, we were asked to give advice on which he should choose, a share sale or an asset sale, based on his objective. What's his objective? He wants the maximum amount of cash so that he can pay off his personal debts. We're told that the purchaser has offered 2 million to acquire the shares in Footloose Limited, or 2.1 million to acquire the assets. So from a non-tax practitioner's perspective, looking at that initially, it might look like, oh, you're going to get more money for the assets, therefore you should just sell the assets. However, we know from a tax perspective, it's not that straightforward, and we need to go and look at tax implications of a share sale and the tax implications of the individual sales of each of all of the assets and compare the two. We're given a statement of financial position at the 1st of December 2024. So what do we have? We've got land and buildings. We've got plant and machinery and a trademark. For plant and machinery and trademarks, in addition to those two assets being chargeable assets, they are also assets on which capital allowances will have been claimed. So we need to be mindful of the potential for a balancing adjustment. We've also got some stock, debtors and creditors, and then we've got our share capital at 100,000. You can see that matches the base cost of his shares. So that's our statement of financial position. We're going to take the information then from the statement of financial position in determining the gains and losses, if any, and calculating the tax implications. So additional information in relation to the assets are: we've got land and buildings, the retail premises acquired in 2003 for 500,000, and the current market value is 1 million. The plant and machinery was acquired in 2016, and the current market value is 50,000. We'll be interested from a tax perspective in what's the tax written down value. And 2016 is more than 8 years ago, so the tax written down value there will be nil. For the trademark, it was purchased for 300,000 in June 2023, so that was only in the last accounting year, and it's being amortized over 5 years. We know a trademark is an asset that could qualify for capital allowances on specified intangibles, and the choice there is either amortization or 7% per annum for 14 years and 2% in the 15th year. So bearing in mind that the amortization is over 5 years, it's likely that capital allowances were claimed over the 5 years. And current market value there is 500,000. Stock on hand then, we're told at the 31st December 2024 was purchased for 100,000. And if you were to look back at the statement of financial position, you'll see that the value of the stock on hand is 100,000. So there's no tax implications there because the value and the original cost are the same. And then a reminder then of the requirements. We're asked to analyse the tax implications. That's the full case study then. In the exam, I'd be reading the requirements twice. Okay. First of all, I'm scanning the requirements to see what do I need to keep in mind when I'm reading the question. And then the second time I read the requirements, okay, how now do I attack this answer? What do I need to do first? So the share sale versus the asset sale. It might be useful to first understand what's happening from a share sale perspective and what's happening from an asset sale perspective. So as far as the share sale is concerned, Mr. Strike owns the shares in Footloose. So if he sells the shares in Footloose, the cash comes directly to him. Now, what are we to be mindful of? He wants the maximum amount of cash. So a share sale will result in the cash coming directly to him. An asset sale, however, Footloose owns the assets and Footloose is selling assets. So where are the proceeds of disposal of the assets going to go? Into Footloose. Who needs the proceeds? Mr. Strike needs the Mr. Strike needs the proceeds. Therefore, we're going to have to liquidate Footloose to get the cash back to Mr. Strike. Okay, so it's important to have that kind of visual in mind as you're going down through the tax implications of each. Next one then, as far as the share sale is concerned. So here's where we start having to think about each of the different tax heads. And in the order that I usually go down through them is, I think about VAT first, then stamp duty, then capital gains tax and corporation tax. You can decide to go through them in whatever order you like. So from a VAT perspective, first, if he sells shares, he will not be required to charge VAT on the sale of the shares because shares are exempt from VAT. In your exam, don't forget that there's marks going for stating that there are no tax implications. Okay. The next tax head that you might think of is stamp duty, but that's not Mr. Strike's concern. That's the purchaser's concern. So here's where you're not going to get marks for talking about there being no stamp duty because it's not one of the tax implications for Mr. Strike. The only time that we would think about stamp duty from the seller's perspective is if the buyer was comparing the costs of stamp duty between a share sale and an asset sale and was seeking to reduce the purchase price for the difference in stamp duty, which is not the case in this example. So the next tax head I'm thinking of then is capital gains tax. From a capital gains tax perspective, Mr. Strike, in the absence of any relief, he would be subject to capital gains tax at a rate of 33% on the gain on disposal of his shares. What will he be selling the shares for? 2 million. What's his base cost? 100,000. So you have about 1.9 million of a gain before dealing with the annual exemption, and that's subject to tax at 33% unless there's any relief available. Now, what relief might be available? We know already that retirement relief is not, but revised entrepreneur relief is. So we need to identify if he satisfies the conditions. He owns 5% or more of Footloose. Check that condition. He's owned that percentage of the shares for a period of 3 years or more. He's owned them for 10 years. And he's been a director and spent at least 50% of his working time in a managerial or technical capacity. So the conditions for revised entrepreneur relief are satisfied. Now, what does that mean? It means that when we're calculating his capital gains tax, the first 1 million of his gain will be taxed at 10% and the balance will be taxed at 33%. And then note there'll be a half mark maybe for saying that retirement relief is not applicable because he's aged less than 55. So now we want to calculate the amount of the tax. And as far as our tax is concerned, we've got consideration, there's our 2 million, minus our base cost of 100,000, less your annual exemption, we've got nearly 1.9 million of a gain, of which 100,000, 1 million is taxed at 10%, giving us 100,000 of CGT. And the balance then is taxed at 33%. Now, we're used to calculating the total tax, but what we need to get used to in terms of making these kind of decisions or advising taxpayers on these kind of decisions is what's the net after tax proceeds? Because remember, what Mr. Strike is interested in is which one am I going to end up with the most cash in my pocket? So at this point, we need to calculate if you sell the shares for 2 million, how much cash will you have after payment of tax? Your 2 million minus the tax cost gives us 1,603,419. Okay, and that's going directly to Mr. Strike. So next then we've got the asset sale. And as far as the asset sale is concerned, we need to identify what are all of the assets. And if we look back to the statement of financial position, we'll see that the assets include property, plant and machinery, trademark, stock, debtors, and goodwill. The goodwill we don't have a value for. So we've got to calculate the value of goodwill for ourselves. How do we do that? We take the total price that the purchaser is willing to pay for all of the assets, which was that 2.12 million. And we deduct the market value of all of the other known and identifiable assets. Okay. So when we do that, there's our 2.1 million. The property was worth 1 million. Plant and machinery, 50. Our trademark was worth 500. The stock, 100. And the debtors, 250. Total market value then of all of the assets is 1.9 million. So we've got a goodwill figure of 220,000. Okay. Now that we've done that, we can calculate what are the tax implications for Footloose Limited of the disposal of all of those assets. So as far as the goodwill is concerned, we calculated that value of 220,000 in Schedule 2. Your base cost for goodwill is nil, so straight away you've got a gain of 220,000 there. For your property, there's an original cost of 500,000, current market value of 1 million. So we're going to have a gain there of 500,000. Plant and machinery was acquired in 2016 for 60,000. It has a current market value of 50,000. So from a capital gains tax perspective or a corporation tax on chargeable gains, you could say that there is a capital loss. However, that loss is not allowable because capital allowances were given on the plant and machinery. Trademark was purchased for 300,000 in June 2023, and its current market value is 500,000. Is that gain taxable? Yes, it's a chargeable asset, and if a chargeable asset is sold for more than its cost, then that gain is subject to capital gains tax or corporation tax on chargeable gains. Okay, just because a loss would not be allowable does not make the asset outside the scope of capital gains tax or corporation tax on chargeable gains. You've got to be very careful with that. Why did we not take into account the loss on disposal of the plant and machinery? Because the loss on disposal is not allowable when capital allowances have been claimed. As far as the trademark is concerned, it's been sold for a gain. Is that gain taxable? Absolutely. Okay. So the calculation of our gains then we've got, there's our goodwill gain of 220, our property, 500,000. The plant and machinery, yes, there is a loss, but it's not allowable. And then our trademark, there's a gain of 200,000. So the total gains of 920,000 for Footloose Limited will give rise to corporation tax on chargeable gains at an effective rate of 33%. There's 303,600 of tax that Footloose has to pay. Before we start looking at, well, what's the net after tax proceeds for Footloose, there are still some other taxes for us to calculate. So let's move on to the corporation tax implications of disposals of the assets on which capital allowances had been claimed. We've got the balancing adjustment on your plant and machinery. It was acquired in 2016. 2016 is more than 8 years ago. So all of the tax written down value has been reduced to nil. And the current market value of 50,000 minus nil tax written down value means that there is a balancing charge of 50,000. Okay. As far as the trademark is concerned, we purchase it for 300,000 and it's now being sold for 200,000. So if we simply did it's now been sold for 500,000. So if we simply did 300,000 multiplied by 1/5, that gives you 60,000. So you've got 240,000 of a tax written down value. However, the capital allowance, the balancing charge cannot exceed the amount of the capital allowances claimed. Okay, so what we need to do then is we need to adjust the balancing charge for the capital allowances that have been claimed. How do we do that? Let me just show you here. So we've got our 500,000, there's our selling price, minus the tax written down value. And the tax written down value is your cost of 300,000 minus 1 year's worth of amortization of 60,000. That gives you a balancing charge of 260,000. That's much more than the capital allowances that have been claimed. Remember, a balancing charge is clawing back your capital allowances. So we need to restrict the balancing charge to capital allowances claimed, which were 60,000. When we add the two of those together, we get 110,000, and that is the total balancing charges, giving rise to a tax cost, corporation tax, at 12.5%, 13,750. So now we've identified the tax costs for Footloose Limited of the disposal of the assets. We need to now work out how much is left in the company to be paid back to Mr. Strike. So the calculation then of your net proceeds available on the liquidation of Footloose. The total consideration that will be received by Footloose is that 2.12 million, minus the CT on the chargeable gains and the CT on the balancing charges. And then don't forget that there was creditors on the statement of financial position. They would have to be paid off. So that gives us a net 1.68 million of proceeds in Footloose after the disposal of all of our assets. There was no mention in this question of liquidators' fees, but you should note in the exam that liquidators' fees will also be payable, so that will reduce the proceeds further. What happens next? Remember, we said Footloose sells all of the assets, and then the remaining cash will be distributed to Mr. Strike in a final liquidating distribution. So that final liquidating distribution, again, what does that represent? That represents a deemed disposal of Mr. Strike's shares. And on the deemed disposal of his shares, we need to think about what the tax charge will be. In the absence of any relief, there would be CGT at a rate of 33% on the disposal of his shares. Is revised entrepreneur relief available on a liquidation? Well, strictly speaking, the company is not a qualifying company at the date of disposal because it's not carrying on a trade. The trade has ceased, and the only assets that are contained within the company is cash. However, Revenue have stated that as long as a liquidator is appointed and the liquidation is completed within a reasonable period of time, revised entrepreneur relief can still apply. In your answer, then, you would need to advise Mr. Strike that the liquidation should be completed within 2 years. On that basis, then, we can go and apply revised entrepreneur relief to the final liquidation distribution and deemed disposal of the shares. So what are the proceeds of liquidation? The amount of money left in the company is 1,682,750. His base cost was 100,000 minus your annual exemption gives you 1.58 million of a gain. 1 million at 10% and the balance then at 33% gives us a total tax cost of 291,855. Our net after tax proceeds is 1,390,795. But again, note that there will be liquidators' fees that will reduce the amount of the after tax proceeds. So now we need to compare them. And when we compare them, we're required to give a recommendation. Recommendation should be based on meeting Mr. Stripe's objective. And we said that that was that he would have the maximum amount of cash to pay off his personal debts. It's very important in the exam that you write a recommendation. Okay, so show the examiner, see all those things that I've calculated. Here I am comparing the two of them. Here's the difference between the two of them. And here's the English words describing why I'm choosing the one that has more cash than the other. Okay. So our net proceeds of the share sale was 1.6 million. Your net proceeds of the asset sale was just shy of 1.4 million. The difference is 212,000. So that's a significant difference between the two. What's our recommendation? As Mr. Strike requires the money in his own hands to clear personal debt, so I simply lifted that objective from the question in the exam. Because that is his objective, it's necessary to select the option that gives him the highest net proceeds. Here's my English words for what I've just shown you in that table. The net proceeds of a share sale is 1603, and that's 212,625 higher than that of an asset sale. Therefore, Mr. Strike should seek a share sale.